I'm Sudha from Indigo Learn, Onefilm. I'm taking care of ACCA on behalf of Onefilm. We'll start the session. I have a small brief presentation, and we will take that. And then we have our faculty, Aslesha Atul, with us. She's been with Onefilm for quite some time. She has taught us law, and now she's taking accounts. She's taught for CA, foundation, inter, final, all across all the levels. It's a pleasure to have you, Aslesha.
Thank you. Thank you so much.
So I have how many of you are already aware of ACCA fully? You can raise your hands so that I can know. That would help us take you through the demo well. Okay, Bhuvneshwari knows what ACCA is. I assume Anusha knows, Harini knows. Soumya, Sharon, Nikhil, Haniel. Are you guys aware of what ACCA is? Okay. Presuming we don't know, we'll take you through that. No issues at all. So ACCA is an international course. It's also known as Global CA, right? Because of its reach over 180 countries. And we are going to start with the knowledge level. There are 3 levels in ACCA. Level 1 is knowledge level, level 2 is skill level, level 3 is professional. So the first step to the ACCA qualification is knowledge level. And we are here in the orientation class for one of the subjects under knowledge level. Knowledge level is being the first level is a objective paper format, which is, and all across ACCA, we have computer-based exams. And this knowledge level specifically, these 3 papers, which we are going to look into, are on demand. That means that you will have to choose when to write the exam. You have that comfort. ACCA is a very student-friendly course. So you can, for the first level, based on your preparation, you can book the slot whenever you want to write your exam. There are computer centers, approved centers, where you could go and write your exam. Write in the sense, give your exam. There's no writing in ACCA on paper. So these 3 papers of knowledge level are of 2 hours exams. The subjects involved are business technology, management accounting, and financial accounting. And today here we are for the financial accounting aspect. We are having an orientation and a demo class for financial accounting. Now these are the basic level papers. So the knowledge which you get here is a basic level knowledge required all across your ACCA qualification. So you will know in the next few slides that whatever you learn here, all the concepts you learn here are not just basic, but they're also important for the matter that they're going to be used at every level, both skill and professional level, and always in your careers. So please do not think that, this is a simple level, so we can ignore that. This is the most important level, I would say, which I'm sure Aslesha will also agree to, because your foundation is built here. You learn your concepts, and once you learn your concepts strongly, you will be able to excel in your skill and your professional level. And this papers of business technology, management accounting, and financial accounting are also a replica of what you find in your diploma foundation, which is an RQF 4 level. Now, if you look at the slide right now, it is giving you the pass rates given by ACCA itself till June 22 of all 3 papers, that is business technology, management accounting, and financial accounting. So if you look at the numbers, I'm sure you get the assurance that it is quite manageable. The pass rates give you a hope that it's not so difficult. It's only the way you prepare and you present and you get through that exam that it will help you get through this level very easily. But as I mentioned before, the concepts learned here are very important. So that makes this level even more important. Now, the subject relevance for each of these 3 papers which you learn in knowledge level, business technology, management accounting, and financial accounting, leads to other important papers in your next levels. Like business technology concepts are required in your strategic business level leader paper, in your professional level paper. And management accounting is required in both performance management and advanced performance management, and strategic business leader. And financial accounting is required. All the concepts you learn in financial accounting, that is the classes which you're going to start now, is required under financial reporting in skill level and strategic business reporting in your professional level. Now, coming to the important aspect as to why Onefilm and how and what you're going to learn at Onefilm. Onefilm is going to give you all this. The live classes where you build your concepts. We are going to provide you with Kaplan ebooks based learning. So all your classes, live classes, are to be based from the Kaplan ebooks, and we also give you Kaplan ebooks along with the course. So the concepts, if you as you attend the classes, you will understand that what is given here is simple to understand and very, very crisply put, so that the student understands it easily. And every concept has a illustration and an example following. So the test your understanding questions given in Kaplan books really help you understand the concept better, the practical application of it. And at Onefilm, we do not just emphasize on the theory concept, but also the practical application, and which is very essential to appear in your ACCA exams. And all the live classes will be provided as backup classes for your revisions till your exams. We will also have exam kits, which we solve in the class. We'll give you the internal tests at 50% completion of syllabus, 75% completion of syllabus, and you'll have a full mock test after 100% syllabus completion. And if you're already using Onefilm, you all are aware of how comfortable and how easy and how important it is to clear your forums, your doubts. As a student, if you don't ask why, you will never be able to learn it better. And Onefilm helps you in this in a very easy way on our forums. So you can always post your query on the forums, and the faculty and the experts will get back to you at the earliest. So this is the approach which we are going to follow for teaching your ACCA papers.
Thank you, Sudha. So, hello everyone. We are going to start with financial accounting right now. But before we start, let me just walk you through what are the different things we are going to cover in the subject, and also the basics of the subject. And we will also understand what type of questions do you get in examination, what is the examination pattern, and then we'll start with the basic concepts. So let me first walk you through the syllabus of financial accounting. Okay, so financial accounting is a subject if you are a commerce background student, if you've done 11th and 12th commerce, or if you're a BCom student, the subject would be a really easy subject for all of you all, because this is a subject wherein we'll discuss about accounts, basic accounting, and a lot of accounting. So if you are a commerce background student, the subject will be really easy for you and also very interesting for you to understand, and we will understand everything conceptually. Now, looking at your syllabus, let's have a look at what are the things you have in your syllabus. So first two chapters are basically theoretical chapter, but otherwise this paper is a complete practical paper. Yes, you will have MCQ based questions in your examination, but this paper is a complete practical paper. So F1, which is business technology, it is a complete theory paper. However, this paper F3, this is financial accounting, which is a complete practical paper. Now, talking about what are the different things which we are going to study here. So the first thing is introduction to financial reporting, wherein we'll understand what is financial reporting, what are the different forms of business organizations which are run, and then we'll also understand the regulatory framework, what is double entry system of bookkeeping, how the basic transactions are recorded, how the ledgers are balanced. We'll talk of sales, purchases, sales returns, purchase returns, how are discount entries passed, how do we take care of taxes, and also inventory. Then we'll talk of depreciation, acquisition of non-current assets, disposal and revaluation of non-current assets. And then there are preparation of final accounts, intangible assets, receivables, payables, capital structure of companies, bank reconciliation, trial balances. So all these basics which you would have studied at your 11th and 12th level, uh, we are going to cover in all of those. And the main or the most important topic of financial accounting would be the questions which are asked as multitask questions, which are based on preparation of basic financial statements and consolidated financial statements. So there are two types of questions which are asked in your examinations, which we look at in some time. And those questions are generally based on basic finance preparation of basic financial statements or consolidated financial statements. So all in all the basic of accounts is something which we are going to cover here. So all the basic accounts is something which will be covered in this particular paper. Now let's have a look at how the what will be your examination pattern, what type of questions will be asked. And one very important thing which all of you all must know is that there's no negative marking, which means you can attempt the entire paper, and even if there's a wrong answer which you've given, you will not lose any marks. So there's no negative marking, which is a very beneficial point for every student. You can attempt the entire paper. So as Sudha has already told you all, you have 2 hours of time to complete the entire paper. Now talking about the examination format, what would be the format of your examination? So there are two types of questions which are asked. One is multiple choice question and the other is multitask question. So first, let's multiple choice questions. So there are 35 multiple choice questions of 2 mark each. So the first part comprises of multiple choice questions, 35 in number with 2 marks each. So that will give you 70 marks. And then there are two multitask questions. So there are two multitask questions, each one of 15 marks. And you have to attempt all the questions. There's no compulsory question here. You have to attempt the entire paper. It is a 2 hour paper. You have to attempt all the questions. There's no choice. There's no option which you have here. You have to attempt the entire paper. So it comprises of 35 multiple choice questions of 2 mark each and two multitask questions of 15 marks each. So multitask questions would generally be based on consolidation of financial statements, preparation of financial statements, and all of those things. So that is how your entire paper of 100 mark will be covered. 35 multiple choice questions and two multitask questions. And talking about the multitask questions, so if you look here, they've clearly mentioned that the multitask questions will test you on consolidation and accounts preparation. However, this also has to be done on computer only. It is not that you have to type everything. The pattern of multitask question would be a little different, wherein you'll have to figure out, fill in some details. They'll give you basic details, and on the basis of that, they'll give you one long question, and on the basis of that, they may give you some 2 3 sub questions into it, or they may ask you to prepare financial statements but ask you certain figures to be filled. So we'll look at different types of questions which are asked as well. So all in all, this will be your examination pattern, what type of questions are asked, and what type of questions you will have to answer. And there's no negative marking, which is a bonus which you all have. So this was with respect to your syllabus and the paper pattern, as in how the examinations are conducted and how many questions are a part of your examinations. Also, I would like to mention that we always emphasize on an interactive class. We always ask a lot of questions in classes, and we want you all to participate as much as you can. The reason is very simple. When you participate in class, you understand things a lot more detail. So if you have any doubt, please ask. If you have understood things and we ask you, have you understood something, please answer. And if we are asking you any question with respect to the subject, it make sure that you are answering and participating as much as you can. Now, talking about how are we going to go about the subject, or how what will be our approach towards the subject, we'll basically uh, focus more on conceptual understanding. Once we complete a concept, we will take up a question from the exam kit. We will cover all the test you understanding questions in which are a part of your Kaplan material. And apart from that, whatever questions are there in the exam kit, some different questions, some difficult questions, we'll take up all those questions. And when we are solving questions, we want all of you all to give your answers, and only then we will give you the entire solution. So if you want the answer, you will have to solve the question and not wait for us to complete the solution, and you just take care of you just have a look at the complete solution. So it is very important that you focus on everything which is being taught to you. So we'll focus on the conceptual understanding, conceptual clarity of everything, and then we'll take up questions based on every topic. So that is how we are going to cover the entire syllabus of financial accounting. Let's start with financial accounting now. So before we start with financial accounting, let me just give you a brief introduction of what financial accounting or financial reporting actually means. So, as you all know, there are different businesses which are run. Different kinds of business organizations are run. So, it can be in the form of a sole proprietorship, it can be in the form of a partnership, or it can be in the form of a company. So whenever any business organization, whenever any business is running, it can be run into different categories. It can be of different type of organization. Now, whenever a business is being run, there are different transactions which take place in a business. There could be sale, there could be purchases, there could be some other expenses which are incurred. All of these transactions of the business are to be recorded. Now, what is the reason of these transactions, of these business transactions being recorded, or why are these business transactions recorded? The reason is very simple. If I am starting with a business, I should know how, at the end of the year, how much did I earn. So, if I'm doing any business, at the end of the year, I should know how much profit I've made. Will you not want to know what is the profit your business has made if you are running a business? You will definitely want to know what is the profit you're making throughout the year after putting in a lot of efforts for your business. What is the profit has been made? We all want to know that. So all these business transactions are recorded. And why are these business transactions recorded? These business transactions are recorded in order to know what is the profit which is being earned by the business at the end of the year. So at year end, we all want to know what is the amount which is being earned by the business, and that is the reason why we record all the transactions which are happening in the business. Now, when we talk about recording of transactions also has to happen in a systematic form. Proper accounts are to be made. So that's where accounts come into picture. Accounting comes into picture, wherein all the business transactions are recorded, everything happening in the business is recorded, and at the year end there are two specific statements which are made. One is the statement of profit and loss, and the other is statement of financial position. So at the end of the year, wherein everything is made, there are specific formats which have been prescribed for statement of profit and loss and statement of financial position. Now, what do these statements signify, or what do we understand from the statement of profit and loss? Statement of profit and loss basically gives us the amount of profit or loss which we have made during the entire year. So, statement of profit and loss gives us the amount. details of whether we've made profit in the year or whether there's a loss which has been made during the year as a result of the business. So that is what statement of profit and loss talks of. And talking about statement of financial position, statement of financial position is nothing but a balance sheet which specifies the amount of assets and liabilities which a business has. So these are the two most important statements, statement of profit and loss and the statement of financial position, which signify what is the profit which has been earned and the assets and liabilities held by the business respectively. So every business has to record transactions and they make these specific statements. And these statements are then used by the stakeholders, different investors, different customers, suppliers. There are different users of these financial statements. So this is the reason why financial reporting or financial accounting becomes very important or plays a very significant role. So is this basic clear to everyone? So as I've mentioned, I'll not move ahead until I get answers from all of you all. So make sure that you answer whenever a question is being asked. Okay. So this is the reason why we have to record transactions and how recording of transactions happen, how things are done. We'll understand as we move ahead with the subject. But the first chapter is all about basics. So let's start with the basics. So the first chapter is about introduction to financial reporting. We've understood in brief as to why financial reporting is required or what is the reason financial statements are prepared. So talking about accounting, it consists of two elements. The first one is recording. That is, we record all the transactions which are happening in the business. So all the business transactions are recorded whenever we are talking about accounting. The first step is always recording of transaction. And after recording the transaction, there is summarizing of the transaction. Summarizing basically means we make different statements, we make different financial statements which are used by the end users of financial statements. So summarizing, when we summarize, we make different financial statements. We'll talk about management account in some time. So first, let's talk about financial statement. So financial statement consists of statement of profit or loss, statement of financial position, which we've understood just now, wherein we spoke of profit and loss. A statement of profit and loss is nothing but the profit and loss account, and statement of financial position is nothing but your balance sheet. And apart from it, there are some other supporting statements also which are made. One is the statement of cash flow or the cash flow statement, which we call. And then there's SOKI, that is statement of changes in equity. We'll talk of all of these. We'll understand what all of these statements mean in detail as we progress through the subject. And then there are notes to accounts. So notes to accounts are again the supportings which are made. Now, if you look at the balance sheet, we give the final figure of non-current assets, current assets. Now, these non-current assets have another bifurcation. That could be land and building, plant and machinery. So that becomes the part of the notes to accounts. So notes also form an integral part of the financial statements which are prepared. So financial statements in all consist of all of these things. Now moving ahead, let's understand what financial reporting is. So since this is a theory chapter and since your exam is an MCQ based exam, we will go through the theory as well, because since it is an MCQ paper, you can get a theory based question as well. However, there would be practical questions as well. So let's start with the basics. So the accounting system of business records and summarizes the financial performance or position of a business over a certain period of time. A certain period of time, which means at the year end. As you all know, India follows the accounting year, which starts from 1st of April and ends on 31st of March. So that is the certain period of time during which the transactions are recorded and the financial position of a business is analyzed for that time period. So when we talk of accounting system, it is basically recording and summarizing the financial position or the financial performance of the business over a certain period of time. Now, accounting for different countries, accounting period for different countries may be different. In India, we follow 1st April to 31st of March. And this information is crucial for various stakeholders of the business. Can someone tell me who are stakeholders? Who is a stakeholders? If you have gone through business, if you've studied business technology, you would know who stakeholders are. So can someone tell me who stakeholders are? Any idea? Who are stakeholders? Customers of the business, a person who is basically interested in running of the business, who would want to know how the business is being running. So this financial information is crucial for the stakeholders, a person who has interest in the business, correct? So this information is very crucial for the stakeholders of the business, because they will have to analyze, they will analyze as to what are the significant economic decisions which they have to make. Economic decisions are basically money based decision or monetary decisions which are to be made by stakeholders. Now, on the basis of financial statements, the stakeholders may decide whether they want to continue with the company or they want to continue with this particular business or not. So it is of vital importance that these stakeholders have good quality information to be able to make good quality decisions. So good quality information basically means that all the transactions which are recorded shall be presented in a proper manner, so that it is easily understandable by the stakeholders, so that they make a good decision, they make a better decision. So it is very important that all the accounts which are being made, all the transactions which are being recorded, they should be in a proper manner. So here we are going to study about different ways in which the accounts are presented and how they are different people who use the financial statements of a company. So the accounting system of business records and summarizes the financial position, and it is of vital importance to the stakeholder. It has to be a good quality information which enables the stakeholders to make good quality decisions. So here on this chapter, we are going to explore the different nature of businesses and stakeholders, and we'll also identify the information which is required by the stakeholders and how is it used by different stakeholders in a business. Now, let's talk about financial accounting and management accounting. Now, when we talk of financial accounting is basically preparing the accounts of the business, and these accounts are then used by the end users. End users could be the investors, suppliers, customers, government, any such person. Now, say for example, there's a person, Mr. Ram, and Mr. Ram is an accountant of a business. So, say Mr. Ram is an accountant of a business, and being an accountant, his job is to record all the transactions and prepare the financial statements of the business. Now, once the financial statements of the business are prepared, once it is prepared, it is then utilized by, it is then sent to the various end users. End users here could be the customers, the investors, different people who would want to analyze as to what is the financial position of the business in which they have invested, how's the business going on, whether the company is making profits, whether it is making losses, whether whether there is a possibility that the business grows in future. All of this can be analyzed by looking at the financial statements of any business organization. So financial accounting is basically making the financial statements of a business, and for the purpose of external users. It is not for the internal management. Basically, it is for the external users who depend on the financial statements of the company in order to make their decisions. Whereas when we talk of management accounting, now management accounting is something which is very detailed and which is for the internal management of the company in order to make business decisions. So when we talk of management accounting is basically something which is useful for the internal management of the company, internal management of the business, in order to facilitate them to make good business decisions. Now, say there are different business units in an organization. There are different business units. When we talk of financial accounting, when we talk of statement of profit or loss, or the statement of profit or loss, there it gives a consolidated profit of the entire business organization. Now, say for example, Nestle is a brand. There are different products which this company makes. Now, when we look at the profit or loss account of this particular company, we'll look at the consolidated profit and loss account, wherein we'll have a look at what is the entire profit which is being made by the entire business throughout the year. However, we cannot come to know that, okay, by sale of Kit Kat, this much profit has been made by the company, or by sale of some other product, this much profit has been made by the company. So when we talk of financial accounting, it is a total overview which the external users require in order to make decisions. However, when we talk of management accounting, it is something which the internal management requires in order to make business decisions. So they require a more detailed breakup of all the expenses which have been incurred, all the other transactions which have been made by the organization. So that is the difference between financial accounting and management accounting. So let's have a look at it. So talking of financial accounting, it is concerned with production of financial statements for external users. So these are the report on the directors' stewardship of funds entrusted to them by the shareholders. Now, this line basically says that financial accounting basically lets the shareholders or the investors or the stakeholders know how the money which they have given to the company has been utilized by the directors. Or directors are basically the people managing the affairs of the company, so they are the ones who are utilizing. Now, say you have invested some money in Reliance Industries Limited, now which means that you are owner of Reliance. Are you going to Reliance's office and managing the business there? Do you go to Reliance's office stating that, no, I have one share of Reliance, I am an owner, I am a shareholder, so which means I am the owner of Reliance, so I'll come to the company? Or do you go to the company and take the business decisions there? Do you do that? If you have one share of Reliance, do you go to the company and take business decisions there? You are the owner of the company, but are you managing the company? No, you're not. You're not managing the company. For the purpose of management, there are different people who have been appointed who are the directors of the company. So they take care of how the shareholders' money has to be utilized. So financial statements basically give is a report about how the director has utilized the funds which were given to them. How effectively, how efficiently did the directors utilize the funds which were given to them by the shareholders? So the investors, they should be able to choose which companies to invest in and compare their investments. So investors, they look at financial statements of different companies, and on the basis of that decide whether to invest in a particular company or not. And in order to facilitate that comparison, the financial accounts are prepared using accepted accounting conventions and standards. So say there's an investor, he compares financial statements of different companies. Now, I have some money and I want to choose from three different companies, in which company do I invest so that I make good amount of profit. Now, for that, I'll have to first compare the financial statements, analyze the financial position of all the three companies, and only on the basis of that, I'll be able to make a decision of whether I should invest in this particular company or not. So investors, they have to compare the financial statements. Now, when they have to compare the financial statements should also be comparable. Basically, meaning that in order to compare the financial statements also shall be made on a uniform principle or on uniform concepts and conventions. So there are certain prescribed accounting conventions and standards which are to be followed by the organizations when they are preparing their financial statements. So there are international accounting standards in IFRS, that is International Financial Reporting Standards, which help to reduce the differences in the way in which companies drop their financial statements in different countries. So, say there's an investor, Mr. Shroff. Now, Mr. Shroff has got money and he wants to invest in money. Now, he has financial statements of different companies. Say there's one Indian company, there's another company which is in the US, and there's another company which is, say, in London. Now, Mr. Shroff, he has to analyze as to in which company should he invest the money he has. It is a very hard-earned money, so investors always have to be careful of where they are investing their funds so that they do not lose upon the money. So now Mr. Shroff, he has to decide whether he should invest in the India-based company or the US-based company or the London-based company. So now here, if all the three countries, they follow different set of accounting standards, different accounting methods, it will become very difficult for Mr. Shroff to analyze the financial statements, compare the financial statements, and make a good decision. So what he'll have to do is he'll first have to look at the Indian accounting standards, understand them, understand the financial statements or of the Indian company. Then look at the accounting standards which are followed in the US. Then and analyze the statement of that US based company. Now this becomes very difficult. This is a very long process. Becomes very difficult, and that is why there is IFRS, that is International Financial Reporting Standards, which are basically followed by almost all the countries now. So that there's a uniformity in how the financial statements are made. We'll learn about IFRS in detail in the next chapter. The next chapter, that is unit chapter 2, is where we'll talk of IFRS in detail. So financial accounting are basically financial statements for the external users. So the financial statements are public documents, and therefore they'll not reveal about details about individual products profitability. So like I was talking about Kit Kat, Nestle, as an investor or as an external user of financial statement, you will not be given a lot of detail about a particular product or individual products profitability. You will not know about that because that is not required. We look at the entire business as a whole. Now, talking about management accounting. Management accounting is something very different. Management accounting is basically where management requires a more detailed and up-to-date information in order to control the business and plan for the future. So as we understood, management accounting is basically for the internal management of the company, wherein they have to make good business decisions. For that, they'll require a much more detailed information and up-to-date information in order to analyze what is the position of the business and plan their way ahead. How do they plan for the future of the business? So management needs to be able to cost out products and production methods, assess profitability, and so on. So management of a business requires a much more detailed information to make sound business decisions. So in order to facilitate this, management accounts present information in a way which may be useful to management by, for example, by operating unit or product line. Say product specific information is given to the management, or information about a specific operating unit is given to the management so that they make a sound business decision. So management accounting is basically an integral part of management activity, which is concerned with identifying, presenting, and interpreting information, which is used for making strategies, planning and controlling activities, making different business decisions. All of these will be facilitated by management accounting, and also optimizing the use of resources. Optimizing use of resources basically mean whatever resources are available with the business organization, there should be a good utilization of the resources which are available. So we always say there has to be optimum utilization of available resources. So in order to make a good business decision, management accounting helps the management in making good strategies for the business, making decisions for the purpose of business, and also making sure that the resources of the business are optimally utilized. So that was with respect to financial accounting and management accounting. Now this is one very important part of unit 1, financial accounting and management accounting. We'll also have a look at MCQ on this. So basically, financial accounting is nothing but financial statements for the external users so that they make a decision. And management accounting is for the internal management so that the internal management, they formulate proper strategies and help them in making good business decisions. So financial accounting is for external users, and management accounts are basically for the internal management of the organization. Now let's talk about who are the users of financial statements. So let's talk about who are the different people who use the financial statements. So this is the list of all the users of financial statements. Let's understand how different people use the financial statements. So first one is investors. So investors are nothing but a person who is investing in the business. Now investor, he will want the financial statements of the company in order to make his decision whether he has to invest in the company or not. So for that, the investors require financial statement. Then comes customers. Now, why do customers require financial statement? Now, say for example, I am into a business of, say, selling ball pens, and I sell ball pens of a particular company. So I sell ball pens. Say I sell ball pens of Link. Link is a company which makes ball pens, and I sell ball pens or of only this particular company. I'm an exclusive dealer of ball pens, which are made by Link. So as a customer, I should know how the company is operating, whether the company, whether the company is charging a higher price to me, or whether the company is making good profits, or is it into losses. Are there chances that the company shuts down? Because if the company shuts down, I'll have no stock to sell. I am an exclusive dealer of product of a particular company, and if that company itself shuts down, I'll have nothing to sell. I'll have to find someone else also if the company shuts down, right? So as a customer, it is my responsibility or it is my right to inspect the financial statement of the company, because I will want to analyze how the company is working and whether the company is in a good position or not. So customers also uh, are the users of financial statements. Then there are suppliers. Suppliers are someone who has supplied something to the company. Now, as a supplier will also want to know whether the company is in a position to pay the amount which is due to the supplier. It may so happen that the supplier has given goods to the company on credit. So the supplier would want to know whether the company is making regular payments or not. So for that, suppliers also are users of financial statement. And similarly, lenders are someone who's given a loan to the company. So if a person has given loan to any organization, he'll definitely first analyze the background of the entire organization, and only on the basis of that, he'll decide whether to give any loan to this particular organization or not. So say for example, even say if you go to a bank to take some personal loan or car loan or any other loan for that matter, the bank will first check your statements. They'll first uh, verify whether you have enough resources, whether you have sufficient funds, or are you capable of paying the loan back, and only then they'll give you loan. They will first do an entire background check, and only on the basis of that they will advance you some loan. Then there's government will again be a user of financial statement. They'll have to ascertain whether the company is paying proper taxes or not. So for that, government also utilizes financial statements. Competitors, that is the other business organizations which are competitors, they will also use the financial statements, because they'll also want to know how much profit this particular company is making. They are doing the similar business, so whether the other company is making profit or not. So we are always interested in how the other person is working, right? So similarly, competitors of a business will also want to know how the other organization is working, what is the financial position of that other organization. Then public also utilizes financial statements. Employees will utilize the financial statements in order to know whether the company is making good profits, or is there a possibility that the company shuts down. Because if the company shuts down, employees are the ultimate losers, because they will lose their job and they'll have to find for some other job. So employees They'll also use the financial statements. If the company is made profit, then the employees will get bonus. If the company is going into consistent losses, or there are a chances of the company being shut down. So the employees, they will also utilize the financial statements. And then finally, the management, in order to make business decision, management will look at the financial statements and utilize the financial statements. Now let's have a look at all of these things in detail. So how do different people use the financial statements, and what is the benefit which they all get by having a look at the financial statement of any organization? So first one is investors. So they are the people who have already invested, or there could be potential future investors. So both the type of investor, they are interested in the potential profits and security of their investment. Now you tell me, will you invest in a company which is consistently making losses and you see that the company has no future ahead? Will you invest in that company? No, definitely not. You will definitely not invest at a place wherein you see there's no scope and there's no profit which the company will ever make. So you'll definitely not invest in a place like that. So investors, they, in order to make investments, they'll analyze the financial statements. So future profits may be estimated from the entity's past performance. So the investor, they'll compare how the company did in the past, and on the basis of that they can make estimates for the future, and on the basis of that they can make their investment decision. And security of their investment will be revealed by the financial strength and solvency of the entity. Solvency basically means that the company is very much solvent. It is in a position to pay off all its debts and liabilities. So the investors, they'll analyze everything, and on the basis of their analysis, they'll decide whether to invest in a company or not. Okay. Moving on to employees. Employees and trade unions, they need to know if the employer can offer secure employment and possible pay raises. So, as an employee of any organization, everyone would always want a secure environment when they are working. Secure employment basically means there's no threat to their job. And also, is there a possibility that they get an increment? So, everyone, when they work, everyone wants an increment. When will there be a raise in my pay? Everyone wants that. So the employees, on the basis of financial statements, they can decide whether the company is doing good, and are there chances of the company, is there any possibility of raise in their pay, is there any security to their employment. So they'll want to know all of this, and because of which they also become the users of financial statements. They'll also have a keen interest in the salaries and benefits enjoyed by senior management. Information about divisional profitability will also be useful in the part of business, if the part of a business is threatened with closure. So, what is the profit which is being made by different divisions of the business will be essential for the employees to know in order to make sure that there's no threat to their job. And then finally, lenders. Lenders will definitely use the financial statements in order to know whether the company will repay, or whether the organization will repay the loan which has been lent to it. So lenders, they'll want to know whether they'll be repaid or not. So it will depend on whether the organization is solvent or not, and whether the organization is solvent or not will be revealed by the financial position of the organization. And what are the securities the loan is backed by, everything will be clearly stated in the financial statements of the organization. And government agencies, they'll also want to know the performance of the company, and also whether the tax authorities will want to know whether the company has paid the amount of tax which it is liable to pay. Suppliers, again, they'll want to know whether the company is regular in making payments or not, and whether they should get into a business deal with this particular organization or not, whether it is safe getting into a deal with this particular organization or not. And that's the reason why suppliers, they also they also use the financial statement. And similarly, customers and public, they'll want to know how the entity is working, and for that the customers as well as public, they emphasize or they utilize the financial statements of the of any organization. And management and competitors would also use the financial statements of business to make economic decisions. So as we've already understood, management, they use the financial statements to make business decisions, and similarly competitors will also use the financial statement of their competing organization in order to make certain business decisions. Management, however, would predominantly use management accounting information as their main source of financial information for decision making. And the competitors, they'll use the final accounts which are available with them in order to make business decisions. So with this, we've now understood who are the different users of financial statements. Now here comes the first question. I want all of you all to answer this question. You will definitely be able to answer this if you have understood whatever we've discussed till now. So the question is, which of the following users do you think require the most detailed financial information to be made available to them? So which of the following people do you think require the most detailed version of financial information made available to them? Is it competitors? Is it management, trade unions, or the investors? What do you think is the correct answer? What do you think is the correct answer to this question? Which of these people will require the most detailed version of financial information? Okay, Hanil says investors. Any other answers? There's only one correct answer to this. So, okay, so Hanil has changed answer to B. Nikhil says B. Okay. So yes, the correct answer is B, management of the business. As we've understood that the management, they require a very detailed version of financial information because they want to make business decisions. They have to make business decisions. They have to utilize the resources of the organization in a proper manner. And for that, it is the management of the business which requires the most detailed financial information. So the correct answer to this question is option B, management of the business. Now let's move on to another topic, and here we'll discuss about types of business entity. So talking about types of business entity, there are basically three types of business entities which we will talk about right now. First one is a sole trader. Now, sole trader is basically a single person who's running a business. Now, say for example, there's a person, Mr. Raghu, who runs a grocery store. So Raghu, he's a person who's running a grocery store. Now Raghu is the only person, he is the owner of this business and he takes care of everything. Everything related to the business, everything is dealt with by Mr. Raghu. Raghu takes care of all the expenses happening. Raghu takes all the important business decisions. Everything is done by only and only by Mr. Raghu. So when we talk of a sole trader is basically a person who owns the business, and the business is also operated by that one person. So here Raghu is the whole and soul of the business. He's the owner of the business and he's the person who takes care of all the operations of the business as well. So here Raghu is a sole trader. There is no legal distinction which the grocery store has or which the grocery business has from its owner. So in case of sole trader, there is no separate legal entity. So if there's any commerce student here, you would know what separate legal entity means. Can someone tell me what separate legal entity means? What is separate legal entity? This is a very talked about concept whenever you're talking about a company or a limited liability partnership. Owner and the business are distinct person. Basically, there's a separation of business. The business gets a legal entity of its own. So when we talk of separate legal entity, this exists in only two types of organization. One is a company and other is a limited liability partnership. However, when we talk about a sole trader, there's no separate legal entity or there's no legal distinction which is enjoyed by the sole trader. If anything happens to the business, if if any losses are being incurred in the business, say the grocery store is going into losses, do you think Raghu's personal assets can also be utilized to pay off these losses? Can Raghu's personal assets be utilized to pay off the losses of the grocery store in this particular situation? Yes, definitely yes, because there's no distinction between the ownership and the business, as a result of which in case the business is going into losses, Raghu's personal assets will also be at risk, and he'll have to pay money out of his own pockets. So, this is what happens in case of a sole trader. The second type of organization is a partnership. So, when we talk of partnership, there are two or more people who come together and who are together running the business. However, in case of partnership as well, there's no distinction. It is only that there are more number of people here than a sole trader. There are two or more people here, at least two people in case of a partnership, and they jointly manage the business. There's In case of partnership, the people who jointly manage the business, they are called as the partners, and the partners, they also have unlimited liability, which means there's no security to the partner's personal assets as well. In case anything happens, in case there are any losses, any liabilities of the business, the partners will also have to pay money out of their own pockets. And finally, talking about companies, so unlike sole traders or unlike partnership, company form of organization is where there is separate legal entity. A company is enjoys a separate entity. It is an artificial person created by law. It comes into existence by a process of incorporation. So a company, unlike sole traders and partnership, they are separate entities. They enjoy a separate legal status, and the owners are basically people who are investing in the company. They are the owners of the company. They invest in the company, and in return they receive profits in the form of dividend. So, and when say you've invested in Reliance Industries Limited, you are an investor of Reliance Industries Limited. Will you be personally liable for the liabilities of this company? Are you personally liable for the liabilities of Reliance? You are an investor here. You are a shareholder of Reliance Industries Limited. So, will you be personally liable for the liabilities of Reliance? No, you will not be personally liable for the liability. So, the shareholders or the person who is investing in a company will not be liable or will not be personally liable for the liabilities of the company. So, these are the three different forms of business organization: sole trader, partnership, and company form of organization. So let's quickly run through these three different types of business entities. So sole trader, it is the most simplest form of business organization, owned and operated by one individual. And yes, there may be different employees which the sole trader has in his business, but again, the whole and soul of the business is only one person, and there's no legal distinction between the owner and the business. And the owner receives all the profits of the business but has unlimited liabilities for all the losses and debt of the business. So all the profits, they belong to the owner, and in case there's any losses or there are any liabilities or debts of the business, it is the owner who will be responsible for the debts and liabilities as well. And the capital is nothing but the money which is brought in by the person when he's starting the business. So it is the money which is put in by the owner of the business. That is the capital. The owner can also bring in some additional capital depending on the requirement of the business. And this capital of the sole trader. Now let's understand this. So say Raghu started a business, he brought in some X amount as capital of the business. So this is capital. Now there was a need of additional funds in the business. So Raghu, he introduced additional capital, or he brought in some additional capital. There was need of funds, so additional capital was also brought in. So we add the additional capital. Now say Raghu has withdrawn something from the business. So we call that as drawings. Drawings are reduced from the capital. In case the business has made profits, those profits will be added to the capital. In case the business make any loss, the losses will be deducted from the capital of the owner. So when we are talking of a sole trader, all the adjustments are made in the capital account of the sole trader. In case he withdraws something from the business, that amount is also reduced from the capital of that capital which is being contributed by the sole trader. So that was with respect to a sole trader. Now let's talk about partnership. So partnership is again, it is similar to sole traders. It's just that the number of people here are two or more. There has to be at least two owners in case of partnership. So they jointly own the business and they are jointly and severally liable for the losses of the business. Jointly and severally basically means jointly as well as individually liable for the losses which the business is making. And the capital structure of partnership is similar to that of a sole trader. Each partner will have financial interest in the business, and this will be divided between a capital account and a current account. So, current accounts are basically for adjusting the money which is earned by the business in the form of profit, and capital account is basically the amount which is brought in by the partner as capital. So, capital account is normally a fixed amount that will only change upon partner joining or leaving the business. And the current account, it includes the share of profit or loss that the partners are entitled to. So as I told you, capital account is the amount which is brought in by the partner, will be touched upon only if he is leaving the firm or a new partner joining in. However, current account is where all the profit and loss adjustments with respect to the partner are made. And then comes limited liability companies. So companies, they are separate legal entities established by the process of incorporation. There's a complete process of incorporation which has to be followed, and only then companies come into existence. The owners, they invest capital in the company and receive in return the dividend, the profits of the company in the form of dividend. Shareholders are not personally liable for the debts of the company. However, they may lose their investment if the company becomes insolvent. Now, what does this mean? You all know that there are two types of shareholders: equity shareholders and preference shareholders. Now, when we talk of liquidation of a company or winding up of a company, whenever a company is liquidated or whenever a company is being wound up, at that time, the shareholders are the last ones to receive back their money. So, firstly, all the secured creditors, secured debenture holders, then the unsecured credit are paid, then the unsecured ones are paid. All the debts and liabilities of the companies are first paid off, and if after paying off everything, if there's something left, that will be then given to the shareholders of the company. So this is what this particular sentence emphasizes on. It basically says that the shareholders, they are not personally liable for the debts of the company. However, in case of company's insolvency, in that situation, there is a possibility that the shareholders, they lose their investment. It is not necessary, or there's no guarantee payment which the shareholders will receive in case of winding up or liquidation of the company. It is possible that they receive the amount. However, in case there's no sufficient funds the company has after paying off all the liabilities, the shareholder will not receive anything. And these companies, they are managed by a board of directors who are elected by the shareholders of the company. This capital structure is more formalized than that of a sole trader or partnership. Shareholders cannot make withdrawals or drawings from the business like the sole trader or partner makes. So shareholder, he cannot say, okay, I'm in need of money, so I'll withdraw money from the company and then invest it again. That is not possible in case of a company. They receive a return on their investment in the form of dividend, which is basically nothing but the profit which is made by the company. So this is what the shareholders receive from the company when they invest in a company. So are you clear with sole trader, partnership, and company form of organization? Is this clear to everyone? Any doubt? So let's now have a look at the comparison of companies to sole trader and partnership. So company, the first and foremost comparison between all these form of organization is that company enjoys a separate legal entity. However, sole traders and partnerships, these form of businesses, they do not enjoy any separate legal entity. They are not different from the owner. Now, when we say that a company enjoys separate legal entity, a company is capable of holding property in its own name. So, since a company is a separate person, a company can hold a property in its own name. However, that is not possible in case of a sole trader or a partnership form of business. So, the property of limited company belongs to the company, and change in the ownership of shares in the company will have no effect on the ownership of company's property. Now, this particular sentence basically means, say, I am a shareholder of Infosys. Now, Infosys say has certain property which is in the name of the company, that is Infosys. Now, if I sell my shares to someone else, I sell my Infosys shares to someone else, that will not bring any change in the property of Infosys. The property will still belong to Infosys. So, separate legal entity gives the company a right to hold property in its own name. A company can hold property in its own name, and change of owners, change in the ownership of the company will have no impact in the change on the property. However, when we talk of partnership, the firm's property is basically the joint asset of all the partners, and it belongs to the partners. And as and when they leave the firm, they can also take the assets with them. The assets will be divided, and the portion of the asset will be given to the partner who is leaving the firm as well. So that becomes the main distinction between company and partnerships. The next distinction is with respect to transferability of shares. Now, in companies, transferability of share has can be done at any time. If I am holding shares in a company and I want to transfer these shares to someone, I can do it without, irrespective of whether I've obtained approval from any other shareholders or not. I do not have to seek permission from the other shareholders before I'm transferring the shares. However, when we talk of a partnership, if I'm a partner in a partnership firm and I want to transfer my share in the partnership to someone else, I cannot do that unless and until I've obtained consent of all the other partners. So, transferability of shares in a company is very easy, can be done without the consent of the other shareholders. However, in case of partnership, if you want to transfer your interest in partnership to someone else, say I say that okay, I'll now make my brother the partner in this particular partnership firm. I no longer want to continue as a partner here, but for that I'll have to first obtain consent of the other partners and all the other partners. If any one of them says no, I cannot do so. So transferability of shares is easy in a company, not easy in a partnership. Now, since the company is a legal person, a third party can file a case against the company and can also be sued by the company. A case can be filed on the company, and company also has the right to file case on some other person. So that is one that is called as sued and being sued upon. A company, since it enjoys separate legal entity, it can be sued in its own name and can also sue some third person. Talking about security for loans, so a company has a greater scope for raising loans and may secure them with a floating charge. Floating charge is basically a security which is created on the current assets of the company. What are current assets? We'll understand in some time. These are basically assets wherein the value it keeps on fluctuating. There's no fixed value, but their value keeps fluctuating. So, floating charge is basically mortgage over constantly fluctuating assets of a company, providing security to the lender of money to the company. So, a charge is created, a security is created on the assets of the company, and it does not prevent the company on dealing with the assets in the ordinary course of business. Current assets may basically include inventories, stock which the company has. And however, it is not possible in case of partnership. Creation of floating charge is not possible in a case of partnership and a sole trader. Talking about taxation, now Companies tax separately from its shareholders. However, talking about partners and sole traders, they are personally liable for the taxes of the business, for the profits which they are making from the business. They are personally liable to pay taxes on the profits of the business which are being made. However, when we talk of a company is completely taxed separately. There's a complete separate taxation which happens with respect to the company. However, that is not the case with respect to sole proprietors and partners. They are personally liable to pay tax on the profits which are made by the business which they are running. So these were some point of comparisons between company, sole traders, and partnerships. Is this clear to everyone? So till now we have understood what is financial reporting. We have understood what is the difference between financial accounting and management accounting, and then we have understood who are the different people who are users of the financial statements. Post which we have understood about three different forms of business entities: sole traders, partnership, and companies. So these are the different things which we have discussed till now. Now let's talk about some of the disadvantages of incorporation, or what are the disadvantages of being a company. Till now we have understood, okay, company form of organization is a very good form of organization because it provides a lot of flexibility, uh, and there's no personal risk. There's no personal risk which the owners of the company have to actually bear. But now let's understand about a few disadvantages of incorporation, or disadvantages of a company form of organization. So the company, they'll have to register themselves in order to incorporate a company. There are different forms which have to be filled in, and for registration also there's a registration fees which has to be paid. There are certain other legal costs which have to be paid. So there are different formalities which have to be fulfilled whenever a company is being incorporated, which is a process which takes up time as well as money, because registration fees and legal costs, there are different costs of incorporation as well. And in addition, it is normally requirement for a company to produce annual financial statements to the registrar. So a company has to file its financial statements with the registrar every year. So it is a mandatory requirement. If you have been incorporated as a company, the company will have to every year furnish the financial statements, file its financial statements with the registrar of company, and also the financial statements of the company shall be audited. So audit again becomes a mandatory thing when we are talking about a company form of organization. However, this is not mandatory in case of partnerships and sole traders. They are not required to file their financial statements with someone, neither they are required to get their accounts audited unless and until the requirements are met or the threshold limits are met. There's no compulsion of audit when we talk of partnership or sole traders. Then the registered company's accounts and certain other documents are open to public inspection. So accounts of the company and certain other documents of the company, they are open, they are public documents. So the public has access to the company's documents. However, talking about sole traders and partnerships, these are personal businesses which are being run by people. So their accounts or their documents, they are not open for public. They are not public documents as such. And there are some stringent rules which have to be followed by companies, and there are different formalities, different compliances which have to be followed by company form of organization. However, that is not a case in case of sole proprietorship or sole trader and partnership. And members of the company, they do not take part in the management of the company unless and until required. It is the directors of the company who take all the important decisions, and they are the ones who are carrying on the business of the company. However, this is not something which happens in case of partnership. In case of partnership and sole trader, it is the partners themselves, or the sole trader himself. He takes care of the uh, business. He takes care of managing the business and taking the important business decisions. So this was with respect to the different form of entities and comparisons between them.